Looking at the monthly chart, the macro trend shows a powerful, textbook bullish structure. For the vast majority of the preceding months, our green 8-month moving average has sustained a clean position above the red 21-month moving average, confirming that the long-term trend momentum remains firmly in favor of the bulls. This structural uptrend is heavily validated by dominant buying pressure across both price and volume. On the main chart, green bullish candles heavily outnumber and dwarf the red bearish candles. Looking at the volume bars at the bottom, we see the exact same pattern. Green buying volume consistently outperforms red selling volume, proving systematic institutional accumulation on the macro scale. The price profile on the left highlights a massive, multi-tiered accumulation base. Price initially spent 4 to 5 years consolidating within a range between 1911 and 3310. Following that, it stepped up to form a higher base, trading within a secondary range of 3070 to 4118 for another 2 to 3 years. This cumulative 6 to 8 year consolidation built a monumental launchpad of energy. The definitive structural breakout finally occurred when the price surged out of this multi-year secondary range with a long, high-momentum green candle. To execute this setup safely, our entry point is established at approximately 4,475. This entry timing deliberately aligns with the opening of the second candle right after the breakout, ensuring the momentum is verified. For risk management, our stop loss is placed at around 4,118. This level is strictly defined by taking either the absolute low of that first breakout candle, or its midpoint, whichever of those two technical markers sits lower. This gives the macro trade proper structural breathing room, while heavily capping our downside.
We ride this explosive upward extension and plan our final macro exit at approximately 10,000. This target triggers right after the next extended long green candle prints, allowing us to take profits directly at a stalling pin bar candle, which typically signals that the immediate buying momentum is exhausted. Let's break down the exact mathematics of this trade. By entering at 4,475 and exiting at 10,000, our total captured reward is a massive 5,525 points. Meanwhile, with our stop loss firmly anchored at 4118, our total risk exposure is strictly limited to just 357 points. When you map this out, it leaves us with an exceptional 1 to 15.5 risk-to-reward ratio. This extreme mathematical asymmetry is exactly what we look for in long-term multi-stage breakout setups, ensuring our upside heavily outweighs our downside.